Welcome everyone. We have a lot to get to in this video. Of course, we're going to be talking about my portfolio, the Story Fund. This is my growth center portfolio. If you're new to the channel, I follow this at least a couple times a week on this channel. It is a growth centered, technology focused portfolio that my mission is to beat the S&P 500 right now. Of course, with the tech sell-off, I'm a little bit behind. I'll be real with it. I'll show you an update. Right here, I'm a little bit behind. The returns are 9% against the S&P 500's 15%. So I'm behind right now, but as you can see, I've been catching up. I've been making some ground and closing that gap between my portfolio, the Story Fund, and the S&P 500. But regardless, in this video, we're going to be doing an update on the Story Fund. I'll be showing you all the buys and sells that I've been doing, all the changes I've been making to the portfolio. But we also have some news to get to. It turns out that Amazon is making a bigger push into media by buying MGM and a bunch of other huge franchises, of which I think the most valuable is probably the James Bond franchise. So big move by Amazon that raises the questions of Netflix. Netflix is sitting on the top of this hill. They're the king of the hill with the subscribers and with the success they've had with streaming. And everybody in the world that has money and has content and media are trying to dethrone Netflix. That's the name of the game. Can they dethrone Netflix? I'm going to give you an updated opinion as somebody that right now I have a lot invested in Netflix. I invested over $10,000 and I'm currently a bag holder holding on to an $835 loss. Now it was a lot worse. It was like a $1,500 loss. We've been again climbing back, making back some of the losses here, but I'm going to go ahead and give you an updated opinion on somebody that's heavily invested in Netflix. It makes up a huge portion of this portfolio. We're also going to be looking at some top investors like Michael Burry and a legendary hedge fund called Kitao Asset Management, and the recent buys and sells that they've done, or at least some new additions to their portfolio in the last quarter, because some of them happen to be ones that are in this portfolio. So I'll show you which ones that Michael Burry has thought are good value, as well as Kitao Management that they put at the top of their portfolio that's going to be very surprising to some people. I think they'll be a little bit surprised that this legendary tech firm chose this stock to put as their number one holding. So we have a lot to get into. We're going to jump into all of this. If you like this type of content, you can consider subscribing to the channel with the little bell. That makes it so you get an alert. You can also thumbs up the video. That helps it spread to other people. So we grow our community here, our little family here a little bit bigger. And if you really like the content, if you're wanting to have more and more of this, you can also consider supporting the channel with the Patreon. Of course, you get a bunch of benefits and perks and exclusive content and yada yada, all that good stuff as well. Now let's go ahead and start off with the Story Fund. Like I said, this is my personal portfolio. Well, I guess it's not personal, it's kind of public, but it's my own portfolio. It's real money. I invest money into it all the time, every single month. And my goal is to beat the S&P 500. And the way that I'm trying to do that is by having exposure to certain industries and certain companies that I think have more compounding in their market cap ahead of them than the rest of the S&P 500. Now, in order to do this, I have to pick out companies very carefully, ones that I think have good risk-adjusted returns. I have to weight the portfolio very carefully, right? I can't invest too much money into the wrong companies. So I've given some thought into how I'm weighting the portfolio. I've given a lot of thought into the companies that I'm picking, and I've tried to organize what I think is a really well-rounded, technology-focused portfolio that I do think has a good chance of beating the S&P 500 over the long term. Now, what we've seen so far is that at a certain point, at the very beginning of 2021, I was way ahead of the S&P 500, and we know what happened. All of a sudden, the high multiple growth stocks had a major sell-off. A lot of them corrected. I knew that this would happen eventually. Luckily, I didn't have all of my portfolio exposed to these type of companies. The ones that were very speculative, the ones that were very high risk, were a smaller portion of my portfolio. But nonetheless, those came down sometimes 50, 60%, and it took me back down to the S&P 500 and even below it. And since this point, I haven't recovered fully. I'm at a 9% return overall, while the S&P 500 is at a 16%, or right now a 15.3% return. So I'm getting closer, but I haven't fully recovered. Why is this happening? Why is my portfolio not performing as well as SPY? I think a couple reasons why. I've said this on my other channel many times. We have inflation. It's definitely here. In my mind, it's pretty obvious that we have it, but there's still a lot of debate going on. Most investors have realized that we have inflation, and what they've done as a response to that is the obvious move, which is moving out of growth-centered speculative companies into more of the value companies that their earnings are not so far out in the future. So what that's done as a result is made it so that the returns on this portfolio have fallen dramatically. And I think that a lot of this is due not to the specific companies that I'm picking, but due to the macro concerns, the macroeconomic concerns of inflation. So I think that is having, I'm not trying to make excuses here, but I do think that that is having a significant impact on a technology portfolio that has a handful of speculative companies in it. So I think that's a something to be aware of. That if you have a technology-focused portfolio right now, you can't be surprised that a lot of these companies are trading down to lower multiples. If we see inflation and we see a rise in interest rates from the Fed, a lot of these companies are going to be valued at less of a premium. They're just not going to deserve such a high valuation. So that does have some significant downward pressure, but I think that has been happening for a long time. And I feel like with a lot of these companies, we finally got to the point where now they're kind of down where they belong. If we do have aggressive interest rate hikes, they will come down further though. So just expect that in the future. If we see a lot of inflation, a lot of interest rate hikes in the future, these stocks could fall further, but that's no fault of the stock. That's just the macroeconomics. That's the way things work. And you can learn more about that if you want to learn about macro trends, but it's just something to be aware of. Now, there's a lot going on with the portfolio that I've changed. One thing is that I have the current value looking like this, where I have Netflix as one of the top holdings, and I have it arranged kind of the same way, but I went through and reordered it. And you can look at the previous video of me ranking the stocks to see the new way of ranking it. And I went through and I've done a lot of auto buys to try to fill in these new stocks like Visa, the ones that weren't there before. Atlassian's another one that I recently purchased into. And I added these companies because I think that they deserve to be in a technology portfolio. They're fantastic companies. I think they have long-term growth ahead of them. So in this, I have all the big tech companies at an 8% weighting, which means even if we do have high levels of inflation, I do not believe that big tech is in the same category. These aren't speculative tech companies. Their profits are not way out in the future. Their profits are right now. So they're not going to be as affected in a high inflationary environment. Google will do fine. Amazon, Apple, Facebook, Microsoft, all of those will do completely fine. Their earnings are not 10 years out in the future. The companies that will get hurt in an inflationary environment, Teladoc, Square, Shopify, CLTD, Peloton, basically all these ones that are the smaller, more speculative companies. These aren't big earning companies. In fact, a lot of these aren't even profitable. They're still just growing their revenue. They're not focused on profits. These are the ones that if we have inflation and interest rates going up, these ones will have a lot of pressure on them. So that's kind of the breakup. Now, the nice thing is that around 48% of this portfolio is big tech. And I know a lot of people look at that and they think that's crazy. Why do you have so much money in big tech? I don't think it's crazy. I looked over every single one of these companies in detail. I've spent a lot of time investigating these companies, their balance sheets, their future, the way trends are going, if they have a sustainable business, and the story is just not done with them. These aren't IBMs that are going to fade out in another couple of years. Apple's traded relatively cheap. It's at an average PE ratio with the market, and it's a way above average company. Amazon has a whole logistics. They're growing their moat every single year further and further. They have a bigger moat than most people consider, and they have so many avenues of growth. With Google, the trends are moving away from linear television. Google has half the advertising business. YouTube's growing 40% plus year over year, and so on and so forth. Facebook as well is growing revenue 30%, tons of international growth. Microsoft, you've heard my bull case on this company. It has so much dependable subscription revenue. Nothing is going to touch this company in the next 10 years. I really don't believe so. So I could be wrong, but personally, I feel more than fine putting roughly 40% of my portfolio, or even more than that, into big tech alone. They're highly profitable, reasonably valued. In many cases, I think they're unreasonably valued because they're so undervalued. I think that Google is undervalued. Facebook is undervalued. Apple's debatable, but I don't think it's overvalued by any stretch of the imagination. And then Amazon and Microsoft, I think, are at least fairly valued. So I don't think any of these companies are overvalued right now. So with the portfolio right now and the allocation, I feel very comfortable putting this much of a portion, 8% for each of these companies. And I feel completely fine with that. And then I have another huge chunk of the portfolio with this kind of blue chip, mid-tech, Atlassian, very comfortable subscription company, Disney, they have their challenges, but they're doing just fine. MasterCard, Netflix, PayPal, Salesforce, Visa, Spotify, all these companies I think are fantastic. And they also make up a big portion of the portfolio, like 40%. And then I have like another 10 to 15% that is the more speculative companies that some of these won't be successful. Just frankly, these aren't all sure bets. I would be shocked if every one of these companies were super successful. I'd consider myself very lucky. We have the Pershing Square SPAC, we have Teladoc Square, Shopify, CLTD, Peloton, and DoorDash. I think that all of them have a fantastic opportunity, but not all of these are going to be ultimately successful investments. So that is the breakdown of the portfolio. I'm very comfortable with it, even going into what I think is an inflationary environment. I think I'll do okay because I have such a big portion of it to highly profitable companies, and I only have a small portion of it to the more speculative companies. So even within tech, not all tech is the same. Some of it is much more speculative than others, and I think that my portfolio overall leans to the less speculative side. Now let's go ahead and jump into this first story, which is Amazon, which is now allocated to be one of my top holdings. So I do hold Amazon. If you have a growth technology portfolio, Amazon's probably going to be one of the holdings. But I have some Amazon, but I have even more Netflix. And Amazon is going after Netflix, I think, in a lot of the same way that Apple is going for Spotify, right? The big tech, they don't like that these smaller companies are running away with a technology business that they feel like they should own. Amazon feels like they should have a huge portion of this media business, and so they're going to use their deep pockets to purchase it. And they're going to integrate it with the rest of their membership to make it so it's an easier customer acquisition cost. This is a very similar strategy to what Apple's doing fighting against Spotify. But here we have Amazon, one of my holdings, fighting against another holding that's more controversial, Netflix. And currently I have more money invested in Netflix.
Well, Sarah, Amazon is nearing a deal to acquire MGM, which is now expected to close this week. This confirmed by Mike.
Amazon is buying MGM, and they're expecting the deal to close this week. I heard about this, like rumored, a couple days ago, and now the deal is closing this week. So this is a huge deal, and they're closing it this quickly.
Colleague at CNBC.com, Alex Sherman, according to sources, he says the deal is on track to be between $8.5 billion and $9 billion and could close as soon as this week. Now, this is in line with what I've been reporting in recent weeks. My sources telling me that MGM was seeking that $9 billion number for a sale, and it follows Amazon interest in bulking up its library for Amazon Prime as it competes with the likes of Netflix and Disney Plus. We've reached out to...
Okay, so they're buying MGM for $9 billion, which for a company like Amazon, that's like Jeff Bezos just checking his wallet, seeing if he has any loose cash. Like, this is nothing compared to Amazon, but it is a huge deal in the streaming market. I've seen where big tech is going and where they're putting a lot of effort. There's a couple different categories that they're really pushing hard into. They want to be in fintech. They want to be in artificial intelligence, machine learning, all that type of stuff. But they're also pushing big into media. They're pushing big into music, podcasts, and movies. And they don't like the fact that Spotify and Netflix are there running away with what they believe they should own, which is music, podcasts, and movies. The same thing that Apple's doing to Spotify, I think Amazon is starting to do to Netflix. They're trying to bolster up their library to directly compete with Netflix, and they're taking it very seriously. Even though this isn't a lot of money to Netflix or a lot of money to Amazon, $9 billion is still a pretty big purchase. If we look at what they're actually buying, MGM, they own a lot of the franchises like James Bond, Handmaid's Tale, Rocky franchise, Pink Panther, Vikings, RoboCop, and Stargate, Legally Blonde. Those are the featured ones. So these aren't like the best content, right? This isn't like Warner Media, not even close to that category, but the James Bond franchise is pretty huge. These are still some pretty big franchises. So regardless, we know for sure that Amazon is taking their streaming business very seriously. This is not some small side project for them. They see a lot of return on their investment here, so they're putting a lot of money into this. Now, of course, this purchase from Amazon, buying MGM, comes 1 week after AT&T decided to basically sell or spin off Warner Media and then have that merge with Discovery into one massive streaming service, right? Both of those companies combined equals a really big streaming service. So what you're seeing is a consolidation of legacy media. We have older media, we have legacy media, and then we have new media. And what we're finding is that the tech companies like Apple, Amazon, I would consider Netflix kind of a technology company because they have such a huge emphasis on it. Those type of companies are better at creating media than media companies are at becoming tech companies. So tech companies are becoming media companies faster than media are becoming tech. And what's happening is that media is being forced to just sell the tech. They're saying, we can't do this. We don't know how to grow subscribers. We can't integrate it with our products. We don't really have the money to just produce more and more stuff and buy stuff like Amazon or Apple does. So what we're going to do is we're going to consolidate. We're just going to sell to you guys. And that's what a lot of them are doing. Netflix is buying tons of content. Amazon's buying tons of content. Apple really doesn't have that strategy. Most of their content, in fact, I think all of it is original programming. So that's what Apple's doing. That's why they have a smaller library right now. But they're going the original programming route. But regardless, what we're seeing is big consolidation. Just a week ago, we have AT&T and Discovery merging together to form, not AT&T, but Warner Media and Discovery merging together to form this real big streaming service. Who knows what it's going to look like? They're going to have details out very soon. But right now, the analysis from this, what the analysts are saying is that they don't even really mention Netflix. Even though you think that this would be a big competitor to Netflix, they really say who suffers the big blow here is Comcast's Peacock service and Viacom CBS. Again, the analysts don't think that Netflix is going to be very affected by these type of deals because Netflix has such a massive lead over everybody else. And regardless of how hard Amazon tries or Disney or Apple to beat Netflix in subscribers, none of them are even close right now. They're not close with engagement. They're not close in the ARPU. They're not close with the number of subscribers. So none of them are close. They're all super far away. Even Warner Media and Discovery combined with their combined subscribers are not even half the number of subscribers that Netflix has. And that's assuming that they have no overlap. So if you added both of their subscribers as if they didn't have, if it wasn't the same person, there's no overlap. They still wouldn't even have half of what Netflix has. So I still believe right now that Netflix has a monumental lead over these companies. It's going to take a lot more than finagling and trying to combine different companies and buying and selling stuff to try to beat Netflix. They're going to have to come out with a really streamlined service that continues to have way better content than Netflix at a cheaper price point for a very long time. And I don't think that that's going to happen anytime soon. So in my opinion, I still feel confident about my prediction that Netflix is likely to be the biggest streaming service in the next 5 to 10 years. I think that it really will continue to grow. I think it will have a good chance of being the biggest one. Now, on the subject of the AT&T Warner Media and Discovery deal, I was watching a video after this deal was announced and after it was confirmed that it was going to happen. And this was an interview from Barry Diller, who is a media mogul. He founded Fox Broadcasting, and they were talking about AT&T and Discovery. They were talking about Disney and their streaming efforts. And then Netflix came up. And here's what he had to say about Netflix after he was asked, what does this deal mean for Netflix, right? All these agreements going on, Warner Media and Discovery combining together. How is this going to affect Netflix?
You once said that nobody would really be able to ever compete against Netflix, given its success.
Yeah, well, that's true.
Still true?
Yeah.
So Warner Media, Discovery, this doesn't change that?
I don't think it changes the look, Netflix won this several years ago. They're the only ones who have the scale and the momentum to keep making these somewhat lunatic investments in programming. And it's not.
He says that Netflix won this years ago. It's already been decided. Netflix has already won. That's his opinion on it. Now, of course, we don't know that for sure, but I do agree with him that Netflix is the only one that has the situation to have this much revenue, this much cash flow from just streaming alone. There's other companies that like Comcast and Peacock that they have cash flow, but it's subsidized by their cable business. Or they have Amazon that they have cash flow, but it's basically being subsidized by their other businesses. Netflix is a pure play streaming company that 100% of the money they're spending on movies is coming from their streaming business, right? That is where they're funding it from. So I do agree with Barry Diller. If it was my prediction, I think that Netflix won it as well. Now, the last thing, another related story to Netflix, the last thing I'll mention on this subject of Netflix is that they're actively seeking to grow in video games. And this is a little bit surprising to me. So far, they've been very just streamlined, focused on one thing, which is just video content, movies, documentaries, TV shows. But now they're actively moving into video games, according to The Informant. Now, if we look at this report, it says, reading between the lines, while Netflix, we know that they're seeking to hire an executive to make this happen. They're pushing to video games. They say, while Netflix plans are not public and potentially in flux, The Informant reports that the streaming giant is looking to hire an executive to oversee the gaming effort. A source familiar with Netflix plans to tell Axios, quote, think of this as a smaller version of Apple Arcade. Okay, so the same type of thing as Apple Arcade, but smaller. A reference to Apple's offerings of high-quality, ad-free mobile games offered to paying subscribers. The Netflix offering, two Axios sources say, so this is all rumored, inside sources, would consist of a mix of licensed Netflix intellectual property and original work commissioned from independent studios offered to existing Netflix subscribers. So this sounds like this would just be a value add to the Netflix subscriber. Like you signed up for Netflix primarily just to watch the TV shows and stuff. But now look, you have a video game for Stranger Things or whatever type of original content that they create. Now they can create video games around it as part of a value add. They say the service is far off, possibly launching in 2022, and the plans are all subject to change. So this is all rumored. We don't know for sure whether this is even going to happen, but I do think it's a natural route for Netflix because as they build out their original content, they're going to be wanting to do the same thing that Disney's doing and kind of building a whole ecosystem of gaming, content, everything, merchandise, everything to go along with it. So this does seem like something that Netflix can do in the future. And with the growth of cloud gaming, seems like a natural fit for Netflix. So in summary, right now, even though I'm in the red a little bit on this company, I still remain very confident that the company will offer more value in the future. It'll grow more subscribers. It'll have more revenue. It'll become a company that has a high level of free cash flow and it does share buybacks. And I do think I'm going to work my way back into the green with this holding. It's just a matter of time. Now, moving on from Netflix, there's a couple more companies that I wanted to mention. Two of them are bigger holdings in my portfolio. One of them is one of the biggest holdings that I've been particularly bullish on, which is Google. This is a company that I've said that the stock, at least with the price it's trading at, I thought was one of the best risk-adjusted returns, if not the best growth investment in the entire stock market. Just based off of the downside and the upside, I felt like Google was a very safe bet. And the other one is Facebook. Now, the reason that I bring up these two companies, Google and Facebook, is because I've been looking at 13F filings from different popular hedge funds and popular managers, one of them being Michael Burry, who runs Scion Asset Management. Michael Burry's the genius that he's known for The Big Short, but he's been a great investor before then. He had incredible returns, 200% returns from 2000 to 2006, preceding The Big Short, right? And then he had The Big Short and he over doubled his returns again in 1 year. So he's an incredible investor. And if we look at his filing from the first quarter of this year, two of the biggest bullish moves that he made were Google and Facebook. He had calls on both of them, and they make up a big portion of his portfolio. So he was very bullish on these two companies, and looking at their performance overall since the beginning of the year, seems like it's paid off so far. Google's up 36% year to date. Facebook is up 20% year to date. So both of these have done fantastic. Michael Burry is probably well into the green on both of these. And with my portfolio, I'm seeing the same thing. With Google, I'm in the green. With Facebook, I'm in the green by a lot. I wish I bought a little bit more Facebook. But both of these companies have done fantastic. And I still think, even with Google going up, let's see, it's gone up 36%, right? It's way up this year. I still think it's undervalued. If we look at Morningstar's analysis, even they believe that Google's currently, it's trading at $2,400 a share, and they believe the fair value is $2,900. And they're usually pretty conservative on these type of investments. They don't like to value them based off of just unknowns and predictions of the future that aren't certain. They value them based off of cash flows. And they're saying that Google is undervalued right now based off of its easily predictable future cash flows. So I think that Google remains very undervalued. I'm going to continue to hold it as the top allocation right there with the big tech in my portfolio. But so far I'm up 2,000 on this stock. And I think that over the next couple of years, it will be 2,900 and over 3,000 a share. Now, the last 13F I wanted to mention was from a legendary tech investor called Cacao Management. I think I pronounced that right, Cacao. And they've been extremely successful. They've picked out really amazing growth stories. And I just noticed that their top holding now, the one that they really bumped up, they bought a lot more of it, is DoorDash, which was very surprising to have a firm like Cacao Management have DoorDash as their very top holding. So a little bit shocking to me. They haven't said why. They haven't given a big investment thesis for it. But of course, I have DoorDash as one of my holdings. It's one of the ones down here with a lower allocation, so only 2%. They have 6% invested into this company. So they're very bullish on it. So we'll see what happens with DoorDash. I'm going to continue holding it. I'm excited about the company, even though I'm in the red, but it's interesting to see a firm like Cacao Management invest that much money into it. But we'll see if they end up holding it for the long term or if this is just like some type of short-term trade. Anyways, there's the update for today. I hope you guys enjoyed the video. If you did, like it, subscribe to the channel, all that good stuff. And if you want, you can check out the Patreon. There's a link in the description, or it's Joseph Carlson, or it's patreon.com/Joseph Carlson. And I'll see you guys in the next video.